Hi, with me, Miss Bwalya Cecilia. It's Banking Theory, Law and Practice, Unit 4. So, in today's lesson, we'll look at Unit 4 of this course, which is Banking Theory, Law and Practice. So, Unit 4 is about check. So, we'll first look at the definition of a check, then we can look at the types of crossing of a check, then we can also look at the endorsement, okay, and other things. We'll get to look at that as we go on in the next slides. Okay, so I'll start by defining a check. So I think a check is a bill of exchange drawn on a specified banker and not expressed to be payable otherwise than on demand. So when a drawer draws up a check, it is expected of that person to present that check to the bank for it to be payable to that person. Otherwise, if a person just draws up a check and then puts that check in the pocket, it won't be payable until there is demand made for the payment. Okay, so now we're saying a check is a bill of exchange that is drawn on a specified banker and not expressed to be payable otherwise than on demand. So if that check is just drawn and then put aside without taking it or without presenting it to the bank for payment, it won't be payable, not until the demand is made for it. Okay, so Section 6 of the Negotiable Instrument Act 1881 defines a check as a bill of exchange drawn on a specified banker and not expressed to be payable otherwise than on demand. So like I explained, when the negotiable instrument is drawn, it has to be presented to the bank for it to be payable. Okay. So let us look at the features of a check now. What are the features of the check? What are the characteristics of a check? Number one, it is an instrument in writing. A check or a bill or a promissory note must be an instrument in writing. Though the law does not prohibit a check being written in pencil, bankers never accept it because of the risks involved. Alteration is quite easy, but detection impossible in such cases. Let's take, for instance, if checks were being written in pencil, what would have been happening? There would have been a lot of risks involved with that because a pencil can be easily changed. You just erase that amount that someone has drawn on that check, then you put your own amount and make that check payable over the counter. You get the money. But we're saying also that there is not been any prohibition with a check being written in pencil, but bankers never accept this because of the risks that are involved with this. There are a lot of alterations that would have been there if bankers would have been accepting customers of the bank to draw the check in pencil. No wonder a check written in pencil is not accepted, okay, because of the risks that are involved with that. Then number two characteristic is unconditional order. The instrument must contain an order to pay money. It is not necessary that the word order or its equivalent must be used to make the document a check. It does not cease to be a check just because the word please is used before the word pay. Further, the order must be unconditional. In other words, payment of money is made dependent on the happening of an event or fulfillment of a condition. The instrument loses the characteristic of a check. For example, if the check has a receipt form attached to it, and the banker is directed to pay only if the payee signs the receipt, the instrument cannot be regarded as a check. Number three characteristic is drawn on a specified banker only. So that is the third characteristic of a check. It is drawn on a specified banker only. So we're saying a check is always drawn on a specified banker. The check vitally differs from a bill in this respect, as the letter can be drawn on any person, including a banker. The customer of the banker uh, can draw the check only on the particular branch of the bank where he has an account. So it is the third characteristic of a check. It is drawn on a specified banker only, unlike um, a bill, which is drawn on any person, including a banker. Okay, let us look at the fourth characteristic. This is a continuation here. So the fourth characteristic is that a check um, should be with a certain sum of money only, a certain sum of money only. So the order must be for payment of only money. If the banker is asked to deliver securities, the document cannot be called a check. So a check is only drawn for money, not for securities purposes. Okay. Further, the sum of money must be certain. So this characteristic was saying a certain sum of money only. So a check should be drawn to be payable for money only, and then there should be a certain sum of money that should be drawn on a check. You cannot take a blank check to the bank to say, I need a payment to be done on this check. You have to specify a certain amount of money on that check for that check to be payable. Okay. Then the fifth characteristic is pay to be certain. So the pay has to be certain. The check must be made payable to a certain person or to the order of a certain person or to the bearer of the instrument. So the pay must be certain for a check and it should be made payable to a certain individual. The drawer should draw that check to be payable to a certain individual, um, the bearer of the instrument or the bearer of the instrument. The word person includes bodies, corporate, local authorities, associations, holders of office, such as the principal of a college, director or secretary of an institution. So when we say a pay to be certain, the check should be drawn um, to a specified person. This specified person, it does not only mean an individual. This specified person can be um, a local authority. The specified person can be associations. The specified person can be a holder of an office, such as a principal. Okay. Then number six characteristic is payable always on demand. So a check is always payable on demand. A check is always payable on demand. The words on demand are not used. When the drawing bank is asked to pay and the time for its payment is not specified, it is considered to be payable on demand. So when the drawer bank is asked to pay and the time for the payment is not really stated, it's not specified, it is considered to be, that check is considered to be payable upon it being presented to the bank, upon it being taken to the bank, upon demand being created. Okay. Then the other characteristic, number seven, is signed by the drawer. So a check is signed by the drawer. The check is to be signed by the drawer. Further, it should tally with specimen signature furnished to the bank at the time of opening the account. So when an individual goes to open an account with a bank, that person becomes a customer of the bank once they open that account with the bank. So that signature that they use when opening the bank account, that That is the same signature that is expected to be on the check when they drop up a check to be um, made payable when it is being presented at the bank. Okay, so the check is to be signed by the drawer and it should tally with specimen signature furnished to the bank at the time of opening the account. When I am a customer of the bank and I draw a check to be made payable, I do not have to give maybe my friends to put their signature. No, I have to use that very signature I used when opening my bank account. So as the drawer, I should make sure that the signature that is on the check tallies with the signature that I used when opening up the bank account that I'm using in the bank. Okay. So having looked at the characteristics of the check, we'll look at the crossing of checks. So crossing on checks is of two types, general crossing and special crossing. So there are two types of crossing. We have the general crossing and the special crossing. So general crossing, according to section 123, where a check bears across its face an addition of the words "and company" or any abbreviation thereof between two parallel transverse lines or two parallel transverse lines simply, either with or without the words "not negotiable." That addition shall be deemed a crossing, and the check shall be deemed to be crossed generally. Okay, so that is how a general crossed check is. Then with a special crossing, according to section 124, where a check bears across its face an addition of the name of the banker, either with or without the words "not negotiable," that addition shall be deemed a crossing, and the check shall be deemed to be crossed specially and to be crossed to the banker. Okay, so those are the two types of crossing that we have for checks, the two types of crossing. Now let us look at who can cross a check. Who can cross a check? A check can be crossed by four persons. These are namely the drawer, the holder in due course, and the banker. So the drawer, number one, when a drawer issued a check um, to a party, he will cross the check either generally or specially. So this is number one person who can draw, who can cross a check. Sorry. So we have the drawer, then the holder. Let's see how this happens. Um, when a check is given to the holder by the drawer without crossing, so when a drawer draws up a check and then gives it to the holder without crossing, the holder can cross the check. But if the check is already crossed um, and crossed generally, the holder can convert it into special crossing. So when a drawer draws up a check and that check is crossed generally, the holder of the check can convert that crossing into a special crossing. But a check crossed specially cannot be converted into a general crossing. Okay. Then holder in due course, the third person. A holder in due course can also cross the check provided the check is not crossed generally. So when a check is not crossed generally, the holder in due course can also cross the check. When a holder in due course receives an open check, he can cross the check generally, or when the check is already crossed generally, it can be converted into a special crossing by the holder in due course. But he cannot convert a special crossing into a general crossing. So with the holder in due course, a crossing can be converted to a special crossing, but a special crossing cannot be converted into a general crossing. Then the last person, who is the banker. A banker can cross the check when he receives it for collection. So when a check is presented to the banker receives that check, he can cross it when it is received for collection. A collecting banker normally accepts a crossed check on behalf of the customer for the purpose of collection. But when the collecting banker receives an open check without any crossing, the banker himself will cross the check before sending it for collection. So these are the four people who can cross a check: the drawer, holder in due course, as well as the banker. The next item we look at is endorsements. According to Section 14, when a promissory note, bill of exchange, or check is transferred to any person so as to constitute that person the holder thereof, the instrument is said to be negotiated. Yeah. The essence of negotiation that lies not in mere transfer of the instrument from one person to another, but also in the fact that the transferee gets the right as the holder of the instrument. If the transferee of an instrument cannot be called its holder as defined in Section 8, the instrument is not said to have been negotiated. Okay, so the definition of endorsement: when the maker or holder of a negotiable instrument signs the name otherwise than as such maker for the purpose of negotiation on the back or face thereof, um, or on a slip of paper annexed thereto, also signs for the same purpose a stamped paper intended to be completed as a negotiable instrument, he is said to have endorsed the same, which is the negotiable instrument, and is called the endorser. Okay, so the person who makes an endorsement on a negotiable instrument is called the endorser. Let us look at the kinds of endorsement. Number one, we have endorsement in blank or general endorsement. Endorsement in blank or general endorsement. When the endorser puts his mere signature on the back of an instrument without mentioning the name of the person to whom the endorsement is made, it is called a blank endorsement or general endorsement. So when the person who makes the endorsement, who is the endorser, just puts a mere signature on the back of, let's say, a check, um, without mentioning the person to whom that endorsement has been made. That type of endorsement is called, or that kind of endorsement is called a blank or a general endorsement. The blank endorsement makes the instrument payable to bearer, even though it was originally payable to order. It can be transferred now by mere delivery. Okay. Number two kind of endorsement is conditional or qualified endorsement, where the endorser of a negotiable instrument makes his liability dependent upon the happening of an event which may or may not happen. It is called conditional endorsement. Similarly, where the right of the endorsee to receive the amount is made dependent upon the happening of an event which may or may not happen, um, then also the endorsement is called conditional or qualified endorsement. Conditional endorsement does not affect negotiability. Such endorsements are not usually made. Okay, so this type of endorsement, just from the name, conditional endorsement, it's an endorsement that is made upon a condition like a happening of an event that may or may not occur. So this is the type of endorsement, conditional endorsement or qualified endorsement, which depends upon an event that may or may not occur. The third type of endorsement is endorsement in full or special endorsement. So where the endorser in addition to his signature, specifies the person to whom or to whose order the instrument is payable, the endorsement is called endorsement in full. So when an endorser puts an addition of his signature and specifies the person to whom um, the order of the instrument is payable, the endorsement is called endorsement in full. Any holder can convert a blank endorsement into a special endorsement by writing above the signature of the endorser a direction to pay to himself or to some other person. When he makes it payable to some other person and delivers it to that person, he does not um, he does not um, endorse it himself, and therefore he assumes no liabilities um, thereon as an endorser. When a check is drawn payable to bearer, even a subsequent endorsement in full cannot make it payable to order. The fourth type of endorsement is restrictive endorsement. Restrictive endorsement. So, in an endorsement, restricts or prohibits further negotiability of the instrument. It is called restrictive endorsement. The omission of the words or order does not render the endorsement restrictive. The fifth type of endorsement, which is sans resource endorsement, um, this says ordinarily the endorser becomes liable to subsequent parties in the event of dishonor of the instrument, but if he makes it clear that the subsequent holders should not look to him for payment in case it is dishonored, the endorsement is called sans resource endorsement. The word sans resource means without resource. Okay, number 6 is a facultative endorsement. A facultative endorsement. To make an endorser liable on the instrument, notice of dishonor must be given to him. But if the endorser waives the rights, or when the endorser waives this right by writing notice of dishonor waived at the time of endorsing, it is called a facultative endorsement. Okay. Number 7 type of endorsement is a partial endorsement, where the endorsement seeks to transfer only a part of the amount payable under the instrument. The endorsement is called partial endorsement. Partial endorsement does not operate as a negotiation of the instrument. If, however, part of the amount has already been paid, a note to that effect may be made on the instrument, which may then be negotiated for the balance. Okay, so where the instrument is only being endorsed for part of the payment that is required to be paid, that type of endorsement is called partial endorsement. All right. The next item we'll look at is dishonoring of check. Dishonoring of a check. So the meaning of dishonoring of a check. Dishonor refers to default in accepting a bill or default in payment of a bill, promissory note, or a check when duly presented. So when an individual takes a check to the bank, he presents that check to the banker for payment, he makes an order, and then that check is rejected. That is dishonoring of the check. Okay, so there are some conditions under which a check can be dishonored. We'll look at that in the slide that will come. Okay, so under what conditions can a banker dishonor a check? Number 1, when the customer countermands payment. when a customer countermands payment. When the banker receives instruction from his customer not to pay a particular check, the banker should refuse its payment. Such a stop order should be in a writing signed by the drawer containing details regarding the number, the date, the name of the payee, and the amount of the check. A stopped check becomes a piece of waste paper in the hands of the payee. If the banker pays a countermanded check, he is not entitled to debit the customer's account. Besides this, if another check of the customer is dishonored because of the payment of the stopped check, the drawer can claim damage for the wrongful dishonor of the second check. So when a check is countermanded, let's say um, a drawer draws up a check of 10,000, gives it to worker A, a check of 10,000, and gives it to worker A to be made payable upon demand to the bank, and then he countermands that check, okay, and then and writes up another check to worker B for the same amount, 10,000. The banker, if the banker honors the check for worker A, they pay that money to worker A, yet the check is being countermanded, and then worker B's check is refused for payment. The drawer of the check can claim damage for the wrongful dishonor for worker B's check because the first check was countermanded and the banker did a wrongful uh, honoring of the check for worker A. Okay, so when a check is countermanded, the banker has to refuse its payment. But when another check is refused payment because the banker has honored the check that is countermanded, the drawer of the check can claim damage for wrongful dishonor of the check that has not been countermanded. Okay. Then the other condition under which a banker can dishonor a check is when there is notice of customer's death. On receipt of notice of the customer's death, the banker should refuse payment of checks drawn by him. But if but if but if he is not aware of the death of the customer, he can still honor them. When a person who signs a check in his official capacity dies, check drawn by the deceased can be paid. Okay. So in a situation where the banker is not aware that the customer um, is deceased, he can still honor the checks. But when he's received notice that the customer has passed on, he can dishonor checks that have been drawn by him. Okay, so other conditions when there is notice of customer's insolvency. An individual who's insolvent is that person who is of an unsound mind. Okay, so when there is notice that the customer is insolvent, the banker can dishonor checks drawn by him. When the banker has notice of presentation of an insolvency petition in a court, either by the customer or against the customer, he should stop honoring checks. The notice need not be in writing. In the case of a check drawn by an insolvent partner or banker, can pay it after obtaining confirmation from the solvent partners. As regards a company, the bank should refuse payment of check after he receives notice of the commencement of its winding up. The other condition is receipt of garnishee order. On receipt of a garnishee order from a court attaching the account of a customer, the banker should not honor checks presented um, the banker should not honor checks presented, um, and can place such an account in a suspense, okay, to allow the customer to operate in the balance. Then the other condition in which a banker can dishonor a check is when there is notice of assignment. A customer can assign his bank balance to another person. On receipt of notice of such assignments, the banker should dishonor checks drawn by the assigner. The other condition is notice of breach of trust. In the case of a trust account, if the banker has reason to suspect that the customer is likely to misuse the trust funds, he can refuse payment of checks drawn by the trustee. Defective title is another condition in which a check can be dishonored. So when the banker has reason to believe that the holder's title to the check is defective, he can refuse its payment. Okay, then the other condition is closing of account. So when the bank has to dishonor checks presented after closure of person's account. Okay. So in the following cases also, the bank will stop payment of checks. These are other conditions in which the payment of a check can be stopped. We have when a crossed check is presented at a counter, the banker will dishonor such payment. When a check is presented at a branch other than the one where the account is kept, the bank will refuse payment for such a check. When the check presented is post-dated, the banker will refuse such payment of a check. When the check presented has become stale, the banker will refuse payment of such a check. When a check is stale, um, it is a check that was written too long ago. Okay, so when such a check is presented at the bank will refuse payment for such a check. The other case is where the check is drawn on a slip or paper note confirming to be a definition of a check. The banker will refuse payment for such a check. When a check presented is found materially altered, the bank will refuse payment for such a check. When the amount stated in words and figures differs, like for instance, a drawer draws up a check and they writes an amount to say 10,000 in words and then has a figure. He writes maybe 100,000. The two figures do not match, so such a check will be refused for payment. The other case is when the drawer's signature on the check differs from the specimen signature supplied to him at the time of opening the account. So in such a case, the bank will refuse payment for the check. When the balance at the credit of the customer's account is insufficient to meet the check presented, the bank will also refuse payment. Like for instance, let's say in the account there is 30,000 and then on the check the drawer writes 40,000. The money in the account is insufficient. It's not enough with the money that is being presented on the check. So the bank will refuse payment for such a check. And when the check is presented outside banking hours, such a check will be refused for payment. And lastly, when the endorsement on the check is irregular, the bank will refuse payment for such a check. So these are other cases um, in which the bank will stop payment for checks. Next, we look at loans and advances. What precautions should a banker take in granting loans and advances? Number one is scrutiny of past records. The banker should first satisfy himself that the person approaching him for a loan must be a man of probity and reliability. If he happens to be his own customers, a scrutiny of his bank account and past records will disclose how he has honored his commitments in the past. Okay. The other precaution is analysis of past financial accounts. So to know whether the borrower, this is done to know whether the borrower is a man of business acumen. He must call for copies of his profit and loss account and balance sheets for the past few years. An analytical study of these statements will reveal the steady growth of his business or its declining trend. Balance sheet will disclose his financial strength. Okay, then the other precaution is collection of credit information. He must collect credit information about the borrower, specified credit agencies such as the SAIDs in England and DANS and Bradstreets in America, yet the banker has to gather information from his fellow bankers in bazaar reports. So these SAIDs in England, these are examples of such credit agencies that may provide credit information. Okay. So purpose of loan is another precaution. Banker must also note the purpose of the loan. If the loan sought is for unproductive purposes like marriages and pleasure trips, it is not going to enhance the profit earning capacity of the borrower. The banker should discourage loans for such purposes. If advances are for short-term business requirements for meeting seasonal credit needs, he can recover them easily and hence he can favorably consider such loan applications. The other precaution is among the loan. He should not grant large loans to a few borrowers. He should broad base um, his advances by advancing moderate sums to a large number of customers. The banker should therefore note the amount of financial assistance required. Okay, so that is another precaution that the bank should take. Then the other precaution is borrowing powers in the case of corporate borrowers. In case of joint stock companies which seek advances, the banker should see the exhausted portion of their borrowing limit. He should never forget that any excess borrowing by the company. Then we'll look at the types of loans. So we have two. We have a secured loan and an unsecured loan. A secured loan is a loan in which the borrower pledges some assets, the car, the property, which is used as collateral, whereby the property will be sold at public auction or through some other means of sale. Okay. Then unsecured loan, these are loans not attached to any collateral. There's nothing like pledging an asset. Okay. So unsecured loans are loans that are not attached to. So with unsecured loans are not attached to any collateral because the bank has nothing to go after. Or these are unsecured loans. They are called unsecured loans because the bank has nothing to go after if the customer defaults. They cannot sell your house like they could with a mortgage, for example. Okay. So these are funds for lending. Funds for lending, the following are the sources. We have paid up capital reserves, deposits and other accounts, borrowing from reserve banks, participation certificates, certificate of deposits, commercial paper, only to name a few, undistributed or unallocated portions of the current year's profits. Then we have loans from financial institutions and other sources. Then principles of lending, we have safety. Safety is the most important principle of good lending. When a banker lends certain money, that the advance is safe and that the money lent will come back, while banks are no doubt traders in money. The money is not bank's money but someone else's public at large. Okay, so that is number one principle of lending. It's for safety. Number two is for liquidity. Number three is for profitability. Number four is for productive purposes. Number five, it's for diversification of risk. And lastly, it's for security. Okay, so that is all for Unit 4 of Banking Theory, Law in Practice. Thank you so much.